The unthinkable in markets almost never arrives as one clean disaster. It arrives as a gap between what ordinary investors think is happening and what money is actually doing underneath the surface. That gap is where fortunes are lost. It is also where fortunes are made. Most people believe that when uncertainty explodes, the smart move is obvious. They think you sell, move to cash, wait for the dust to settle, and then come back when the world feels safer. That sounds intelligent because fear always sounds intelligent in the moment. Fear feels like discipline, hesitation feels like prudence, running to cash feels like respect for risk. But in markets, what feels safe and what is actually safe are often miles apart. That is the mother line here. Safety is not an emotion, it is a framework. And right now, the people without a framework are the ones most likely to get hurt. The current environment looks simple from far away. War headlines, tariff noise, oil shocks, dollar weakness, gold surging, inflation still sticky, the SP near highs, crypto ripping, conflicting headlines every few hours. It feels chaotic, but still understandable in the lazy way. People say some version of the same thing. The world is a mess. Nobody knows what happens next. Better wait. That is what retail thinks. Institutions do something else. They do not stare at chaos and ask whether they feel comfortable. They ask where money moves next. That is the whole difference. Once you understand that, the market stops looking like a giant emotional pile and starts looking like what it really is. Capital moving from one industry to another, from one asset class to another, from one kind of risk to another, according to patterns that are much more consistent than the public realizes. And when those patterns are present, uncertainty does not have to mean danger. It can mean opportunity. That is why I do not care very much about predicting the exact outcome of the war, the tariff policy, or the next central bank sentence. Those things matter, of course, but they matter mostly because they influence the next flow of money. I am not trying to win a prediction contest. I am trying to stand where the water is about to rise. That is the real game. Now let me explain what makes this moment especially dangerous. We are not dealing with one isolated shock. That is what makes the current setup so unusual. If you have a single crisis, markets can often contain it. A banking panic without inflation pressure is one kind of problem. A geopolitical event without a major supply shock is another. A trade flare-up without a growth slowdown is another. But when you start stacking them together, the system loses room for error very quickly. Right now we have multiple pressures arriving at once. Oil is unstable because the Middle East remains unstable. Trade policy is uncertain because tariffs and policy reversals keep disturbing planning. The dollar is weaker than the average investor is comfortable admitting. Gold is screaming that the monetary system is under pressure. Inflation is not dead enough for the Fed to feel free. Growth is not strong enough for the economy to ignore higher costs. That is not one problem. That is a compression chamber. And when markets enter a compression chamber, the public usually makes one of three catastrophic mistakes. The first is cash panic. This is the oldest one and still one of the most expensive. A person watches the uncertainty rise, feels the fear, and dumps everything into cash because cash feels neutral. It feels inactive. It feels like stepping out of the fire. But the problem with cash in an inflationary, unstable environment is that it is not neutral at all. It is a slowly shrinking position. If inflation is running above the interest you earn, cash is not safety. It is guaranteed erosion with clean statements. That is a terrible trade. You lock in losses on what you sold, then you accept the silent loss on what you held. And because markets usually recover before people feel emotionally ready to return, the panicker often misses the rebound too. That is how you get punished 3 times with one decision. The second mistake is paralysis. This one looks more respectable. You do not panic sell. You just do nothing. You freeze. You keep your existing positions without reevaluating them and tell yourself that long-term investors do not react to headlines. Sometimes that is wise. Other times it is just fear wearing a wiser costume. If the environment has genuinely changed and your portfolio was built for an older regime, doing nothing is not discipline. It is neglect. A strategy is not the same thing as inertia. That distinction matters. The third mistake is chasing the spike. This is the one that most often disguises itself as intelligence. Retail notices that gold ripped or oil ripped or defense ripped and decides that must be the trade. So they buy what already moved hardest during the emotional phase of the crisis. But those first spikes are often driven by fear and by algorithms reacting faster than human beings can think. Institutions were already positioned or are already trimming into the move. Retail arrives late, congratulates itself for acting decisively, and then gets handed the pullback. That is one of the most reliable ways to lose money in uncertain markets. And the tragedy is that all three mistakes come from the same underlying weakness. No framework. If you do not know how money moves in a crisis, then all you have left is emotional improvisation. That is why I want to give you the deeper structure. When real uncertainty spikes, institutions do not ask, should I be bullish or bearish? They ask four better questions. What phase are we in? What is oil doing? What is inflation and the Fed likely to do next? And which sectors benefit from the new structure while the public is still staring at the old story? That is how they reorient. The first phase is the shock. This is the first days or weeks after the event. Fear dominates. Indexes usually fall quickly. The volatility index jumps. Gold often spikes. Energy spikes. Defense names spike. Retail panics. Journalists become historians before the facts are settled. Everything feels like it must be decided immediately. That is the phase where most people get trapped because they mistake the first violent move for the whole move. But the first move is almost never the whole move. The second phase is repricing. This is where the serious money starts asking structural questions. Is this conflict short or sticky? Is oil going to remain a tax on the global economy? Will inflation reaccelerate? Is the Fed trapped? What does this do to margins? Which industries are about to lose pricing power? Which ones are about to gain it? This is where the market stops reacting only to fear and starts reorganizing according to expected cash flow damage and benefit. That is when the rotation begins quietly. The third phase is the actual opportunity. This is where money stops treating the market like one giant bucket and starts flowing toward the sectors that fit the new normal. And this is the phase retail usually misses because they are either still frozen, still in cash, or still obsessed with whatever spiked first. That is why the market's biggest opportunities in a crisis almost never look like the obvious first headline winners. Now, let me make this practical. When geopolitical tension threatens oil and shipping, energy is the first mover. That makes sense. But within energy, the obvious trade and the good trade are not always the same thing. The public chases whatever oil company or ETF is up sharply in the first wave. Institutions often look deeper: storage, pipelines, terminal operators, refiners, oil services, the infrastructure and support businesses that benefit not just from the shock itself, but from the longer duration repricing of energy security. That is a very different mindset. The same thing happens in defense. Retail buys the famous names because the headlines are loud. Institutions start thinking about specialized systems, component suppliers, drone infrastructure, surveillance, cybersecurity, logistics, and the second-order effects of defense budget expansion, because the big point is not just that war breaks out, it is that once spending priorities shift, certain cash flow streams can remain stronger for years after the public has moved on emotionally. That is where real money gets made. Then there is gold. Most people still misunderstand gold deeply. They think of it as fear in metal form. That is too shallow. Gold is a monetary verdict. It matters because it rises when trust in the paper system weakens, if the dollar is under pressure, if central banks are boxed in, if inflation remains alive while growth weakens. Gold becomes more than a fear trade. It becomes a signal that money is moving out of pure paper comfort and into something harder. And once gold starts behaving like that, you cannot just look at bullion. You have to think about miners, royalty companies, streaming models, and the broader ecosystem around the metal. That is what institutions do. They do not stop with the obvious object. They map the chain around it. Now let us talk about the dollar, because this is one of the most important signals and one of the least understood by ordinary investors. Most people think the dollar is just the currency they live in. Institutions understand the dollar as a pricing engine for almost everything else. If the dollar weakens, commodities often benefit because they are priced in dollars. Gold benefits. Large multinational companies with big overseas earnings often benefit because foreign revenues translate back more favorably. Emerging markets can benefit because dollar-denominated debt becomes less punishing in local terms. Meanwhile, U.S. inflation can become more uncomfortable because imports get more expensive. That is not a footnote. That is a major cross-asset signal. And if you ignore it because currency feels abstract, then you are missing one of the clearest ways the market telegraphs the next phase of rotation. Now let me come to the question that really matters for stock investors. What does this do to earnings? At the end of the day, stocks are still claims on future profits. So if oil is high, transport is expensive. input costs are rising and consumers are under pressure, then some sectors are going to suffer regardless of how exciting the headlines feel. Airlines are an obvious example. Consumer discretionary can struggle when people get cautious. Real estate and utilities can underperform in high inflation, awkward rate environments. Businesses with weak pricing power get squeezed. Companies dependent on cheap financing or stable consumer confidence can look much worse in a hurry. This is why I keep saying the market is not one giant pile of stocks. It is a collection of industries with very different relationships to the same shock. Once you accept that, uncertainty becomes much more manageable. You stop asking what the market will do, you start asking where the money will go. That is a much better question. Now, I want to make one thing very clear. I am not telling you to become a day trader or to turn every geopolitical event into a speculative frenzy. That is not the point. The point is to understand that even if you are a longer-term investor, there is a massive difference between sitting in cash, freezing in place, or owning the right sectors in the right regime. History is very clear on this. After major geopolitical shocks, the broad market often recovers within months, but it does not recover evenly. The leadership changes, the money moves, and the people who understand rotation come out of the event in much better shape than those who simply react emotionally to the headline risk. That is what happened after Russia and Ukraine. That is what happened after 9/11s. That is what happens over and over again. The event shocks people, then the money repositions, and then the winners are determined less by bravery than by understanding. So what should an ordinary investor do right now? First, do not go all to cash simply because uncertainty feels high. That is emotional relief, not necessarily financial intelligence. Second, do not do nothing blindly. Review what you own. Ask yourself whether it was built for the environment we had or the environment we are entering. Third, do not chase the first spike. The initial move is often where fear pays the earliest sellers and punishes the latest buyers. Fourth, understand the checklist. Which phase are we in? What is oil doing? What does that mean for inflation and the Fed? What is the dollar signal? Which sectors are likely to gain pricing power or policy support? Where are profits getting impaired? What is the market still not pricing properly? What is your time horizon? Those questions matter more than any one hot take. And finally, stop thinking like a spectator. That may be the biggest issue of all. Retail investors often experience markets as something happening to them. Institutions experience markets as money moving through systems according to incentives. One mindset creates fear. The other creates positioning. That is the real gap, not intelligence, not secret information. Framework. If you want my plain conclusion, it is this. The unthinkable that is about to happen to stocks is not necessarily one giant crash out of a clear blue sky. It is something subtler and in some ways more dangerous, a massive repricing gap between the sectors the public still assumes are safe, exciting, or obvious, and the sectors where institutions have already started moving because they understand what uncertainty does to money flows. The war is the trigger, but the trigger is not the trade is the rotation that follows, and the people who win in this environment are not the ones who predict headlines perfectly. They are the ones who stop reacting emotionally and start asking where the next dollar is going before the crowd notices it already left.